Welcome to another episode of Healthy, Wealthy, and Wise Retirement Podcast, where certified financial planner Lauren Sherman shares thoughts on having a healthy mind, body, and spirit, an abundance of wealth inside portfolios and out, and lessons learned from clients and mentors over the years.
A big thank you to everyone joining me today as I welcome you in for an impromptu episode to discuss some recent tax proposals. Of course, I am your host, Lauren Sherman, and as always, I'm going to do my best to mute out all of the noise surrounding this issue and simplify this down to a few bullet points we can all understand. And if there is still a bit of confusion after listening, be sure to check out this show's resources where I've provided a written summary. If you avoid watching too much news like I do, then you may have missed it, but recently President Biden and the Democratic Party introduced a new tax bill that could have an immediate impact called Responsibly Funding Our Priorities. We know from decades of past bills approved by both parties, Republicans and Democrats, that the title rarely offers an accurate description, but instead is more of a sales pitch to the public. But without being too skeptical or optimistic, let's dive into the proposal. To start with, much of this proposal focuses on corporations, but since we do financial planning for individuals and couples who are either at or nearing retirement, we are going to stick just to some of the changes that could most likely affect you. Let's start by discussing the proposed changes to tax rates. Currently, the top marginal tax rate is 37%, with our new proposal bringing this up to 39.6%. While just 2.6% may sound like a small number, you may remember from past episodes where we've given examples of percentages being a bit misleading, as this could result in tens or even hundreds of thousands of dollars out the door for many retirees over time. Keep in mind that the Tax Cuts and Jobs Act is scheduled to expire at the end of 2025, at which time the top tax rate would go up to 39.6 anyways. But this new proposal would make this effective right away in 2022. Additionally, this change would hit far more people, as the top rate currently only comes into play for those over roughly $518,000 of annual income as an individual or $622,000 as a couple. With this proposal, these numbers would drop to $400,000 as an individual and $450,000 as a couple. Another wrinkle relating to income tax rates applies to what they are referring to as ultra-high incomes. This is an additional 3% flat tax that would apply to an income over $5 million for couples or $2.5 million for individuals. Over the last decade, our government has printed massive amounts of money, which in turn has deflated the value of the dollar. So for these income limits to be going down instead of going up with inflation, what we're really seeing is a decision to go against the logical next step, and in turn, giving individuals less control when deciding what their money ultimately is used for. So this first proposed change we just talked about was for the top marginal tax rate, as well as an additional 3% for ultra-high incomes. The next proposed increase applies to the long-term capital gains tax rate. Long-term capital gains are what you pay when you sell an investment, which could be a stock, mutual fund, real estate, and so on. But when you sell this investment after owning it for 12 months or longer. Currently, the top rate is 20%, and the new proposal would increase this tax to 25%. Once again, the income for those whom this top rate would apply to would be reduced to $400,000 as an individual and $450,000 as a couple. So they are casting a wider net, so more people would have to pay this top rate. While 20 and 25% might sound somewhat low to some listening, remember this money was first earned in some way, so it's very likely the owner of these funds already had to give up a substantial amount, say 20 or 30% of these funds, in the form of income tax before investing them to even be subject to capital gains rates. Keep in mind, it's not always one tax that has the biggest impact, but the layers of taxes that can dwindle a portfolio. On the other end of the spectrum, for those who are a far cry from the top income limits, those who have had a low enough income to pay 0% on their long-term capital gains would also be affected if proposed changes pass, as the lowest income bracket would be condensed as well. So in plain English, your income would have to be even lower than before in order to pay the bottom rate of 0%. so people would hit that 15% bracket quicker. While the income tax changes we discussed first would start January 1st of 2022, these long-term capital gains tax changes would retroactively start on September 14th of 2021. This leaves investors unable to make any end-of-year adjustments to their planning. I understand why our government would want to do this, but it's really against the spirit of the law to make something retroactively applicable. But when you've been given the ultimate authority, you can make the rules without much in the line of checks and balances. Now that we've given a quick overview of the proposed income tax and the long-term gains tax changes, let's move on to how the proposal would impact retirement plans. The first retirement account change is that high-income earners would not be able to contribute to IRAs or Roth IRAs if their aggregate balance exceeds $10 million. Once again, high-income earners is defined using the same $400,000 of income for individuals and $450,000 for couples. The second change is in line with the first and applies to RMDs, which stands for Required Minimum Distributions. RMDs are what you are forced to take out of your tax-deferred accounts once you reach age 72. In short, the point of forcing retirees to take money out of their deferred accounts, even if they don't need the money, is so the government can collect taxes on these investments. The proposed change would require high-income earners to withdraw, and therefore be taxed, 50% of their account that is in excess of $10 million and 100% of the excess over $20 million. This would keep deferred accounts much smaller and generate a tremendous amount of immediate income for our government to spend. Of course, these deferred accounts could not stay deferred forever, and they would have eventually been taxed upon the death of the owner. So really, this feels a bit like our government is raiding the piggy bank now, which leaves more uncertainty for future generations. The next proposed change regarding retirement plans relate to Roth conversions. A Roth account is one in which you pay the tax up front, then it's allowed to grow tax-free. This is advantageous to many investors as they pay the tax on the smaller amount, then when it hopefully grows to a very large account, they have that money tax-free so they can spend it as they wish without any worry about tax rates. Under the proposal, Roth conversions, which is the process of taking a tax-deferred account, then converting it to tax-free account, this would no longer be allowed for people of any income. This would be a huge blow to retirees, as leveraging Roth accounts is one of the few ways that traditionally Americans have felt a sense of control, knowing that rates cannot be changed since 0 multiplied by any number always equals 0. With these proposed changes, our government would strip Americans of much of the control Roth accounts currently offer. Let's move on to one last proposed change. They tax you when you earn it, when it grows, when you spend it, and about everywhere in between. So why not tax it when you die? Under current law, $11.7 million can be passed from one generation to the next without estate tax. This number doubles for a married couple. Under the proposed changes, this number would drop dramatically down to $5 million or double to $10 million for married couples. This not only applies to financial accounts, but also family businesses, farmland, and much more. A tax that cannot easily be satisfied without dismantling the business or selling off the land. We will stop here for today and keep in mind this quick overview is far from comprehensive. This is only my interpretation of what has been released thus far. This proposal appears to be getting closer and closer to becoming law, but there could still be changes made before anything is put into effect. I feel like I went a little easy on this proposal as there are many areas that are due much harsher criticism than what I have offered. One of the many areas of waste that we didn't talk about in this proposal includes $79 billion that would go to the IRS for quote-unquote strengthening tax enforcement activities and increasing voluntary compliance. This sounds to me a lot like buying the bully a bigger stick, or perhaps an army of bullies. We live in a time where families are asked to tighten the belt and live within their means, yet our government taxes, spends, and wastes money faster than an 18-year-old with big dreams and an even bigger credit limit. While it's tough for me to see the direction our government has taken us the past couple of decades, it always brings me back and grounds me a bit when I have the chance to meet with so many salt-of-the-earth type of retirees. People who are driven by hard work, honesty, and helping those around them. Hopefully, our government can learn from this integrity and the ethics of the American people it represents. I will leave it at that for this episode, but be sure to circle back soon as we dive into the various retirement income strategies. Don't forget to check out the show notes for more info and visit healthywealthywiseretirement.com or wherever you get your podcasts to view past episodes.
Thank you so much for listening and supporting this podcast. If you've enjoyed listening, we would love if you took a quick moment to leave an honest review. Of course, we're shooting for 5 stars, but if you have suggestions to improve the show, we would love to hear from you too. Just click on the podcast name, Healthy, Wealthy, and Wise Retirement Podcast, and scroll down to ratings and review. Thanks again for your support, as this helps us reach a wider audience and help even more retirees just like you. This podcast is for entertainment and informational purposes only and is not intended as a specific tax, legal, or investment advice. Lauren Sherman is a certified financial planner and co-owner of Integrity Wealth Management, an investment advisor serving retirees in search of their own healthy, wealthy, and wise retirement lifestyle.